Okay.
This meeting is being recorded.
Oh,
Yeah, this meeting's being recorded. So good morning, everyone. Um, so I want to do just a little quick introduction and then we'll get started. So welcome everyone. Thank you for joining us. My name is Randy Mayers. I am the Assistant Director of the EOF program, and I'm joined by my colleague, Dr. Diron Corley, who's the Assistant Director of TRIO SSS. And this is another installment in our financial literacy series that we've been doing for, I guess, the past couple of years now. I'm happy to see some students out, and I hope you have questions lined up and or things that you want to discuss. And if you have anything, feel free to put them in the chat as we go through the presentation. But we will also, of course, leave time at the end to answer any questions as well. So definitely ask questions. We want you to leave here having felt like you learned something or you had any questions that you might have answered. So I'm going to go ahead and introduce our speaker. So many of you are familiar with him because you may have been to one of our other financial literacy workshops where he has been hosting, but we are joined today by Mike Newman, and he is going to talk about understanding the basics of taxes. So this is really great timing because we are in the middle of tax season. So if you are no matter where you are in your kind of tax journey, whether you've never filed taxes before, or maybe you have to this year, or you just kind of want to learn more, this is a great workshop for you. So I'm going to go ahead and turn it over to Mike.
Well, Randy, thank you as always, and thank you to Diron as well. I'm always happy to do these financial literacy workshops. And honestly, I'm excited about the topic today because taxes can go in many different directions. Most people are not excited about taxes, but hopefully today we'll go through some of the basics. It will help you get a better understanding of the tax return, taxes in general. And if you have questions, be happy to answer them at the end. The actual presentation will be a little longer than usual. There's just a lot of information to go through. So my hope is that we can touch on it all and still have a decent amount of time for questions. So let's get started. So one important note that I put in here is everything that we go through today is for educational purposes only. So I don't want you to think that whatever we discuss is going to specifically help your tax situation, because it may or may not. So it's always important to discuss any recommendations, things that you talk about with somebody, with a tax advisor, CPA, or accountant, because ultimately, just because one person does something, it does not mean that it is going to be right for you. So moving on here, the first piece I want to talk about is what are taxes? So most people think about them as the money that the government takes from us, or that they use to fill the potholes in the state of New Jersey. But essentially, taxes are compulsory contributions of state revenue levied by different government entities that is ultimately paid by your income, business profits, goods on services that you purchase, etc. And taxes are utilized to more or less maintain a government, whether that's at a state level, a local level, or the federal government level. Okay. Moving on here, what tax system does the United States utilize? Is it a flat tax system? Is it a graduated tax system? So I'm actually going to take the moment. I would like for you to put in the chat what you think it is. Do you think it's a flat tax system? Do you think it's a graduated tax system? And then I just want to see some of the answers, and then we'll go from there. So take some time to put in what type of tax system you think the U.S. utilizes. All right, so we got a couple different answers: flat, graduated. All right, so graduated. So the good news is everyone is technically right. We do use a flat tax system, and we also use a graduated tax system. Oops. So we have two different tax systems that the United States utilizes. At a federal level, it is typically just a graduated tax system. And that means that as you earn more income, you pay more in taxes. A flat tax system means that no matter how much you earn, you pay the same amount in taxes. So an example of a flat tax that most of you are probably familiar with if you live in New Jersey is a sales tax. So a sales tax just means that no matter what type of purchase you make, whether it's a car, whether it's a soda, whether it's a boat, you pay the same amount in taxes as the next person. Okay, so we use both types of these tax systems. We'll talk about them in more detail as we go through the presentation. So there are 3 tax types, which are important because as you get more familiar with taxes, these are going to help you identify ways you can reduce taxes, minimize taxes, and keep more money in your pocket. So you have taxes on what you earn, taxes on what you buy, and taxes on what you own. So we are going to start with taxes on what you earn, because I think most people are familiar with that. So taxes on what you earn, there's 4 basic types. There are more, but these are the ones I think that are relatively important, at least for today. So you have personal income taxes, corporate income taxes, payroll taxes, capital gains taxes. So we will touch on 3 of the 4 of these, which will be personal income, payroll taxes, and capital gains taxes today. We're not going to get into corporate income taxes. That's more complex than we need to really discuss. So taxes on what you earn. Let's start with personal income taxes. So you have 2, more or less basic types of income tax. You have what is called W-2 income, and you have 1099 income. So W-2 income, most people are familiar with. So for example, if you work for a large company or institution, let's say for Rutgers University, for example, it is likely you will receive what is called a W-2. Okay, when it comes to W-2 income, it has its benefits as well as its drawbacks. With 1099 income, that income is typically used for what are called independent contractors, businesses, freelancers. With 1099 income, you can take business deductions, things of that nature. Okay. One important thing as far as a difference between W-2 and 1099 income, when it comes to W-2 income, you only pay what is called your half of self-employment tax. With 1099 income, you pay both halves of self-employment tax. So there are benefits and drawbacks to each, and I'll try to go through those in more detail as we continue. Next, though, I want to talk about what is the difference between a deduction and a credit. And we're going to talk about that more as well when we look through an actual tax return. So a deduction is a actual reduction in your earned income. In other words, if you made $100,000 this year and you were able to take a deduction of $10,000, that would reduce your earned income from $100,000 down to $90,000, and the $90,000 amount would be the amount that you were actually taxed on. When it comes to a credit on your tax return, a credit is a dollar for dollar reduction in the actual amount of taxes that you owe. In other words, if you owe the government $10,000 in taxes and you're eligible for a $2,000 credit, that will reduce your total tax bill by $2,000. So it will reduce it from $10,000 down to $2,000. Okay. So a deduction happens on the top end, basically on the amount of money that you earn, and a credit happens on the bottom end, and it reduces the amount of actual tax that you owe. So one other question I would like to see you all put into the chat is it better to owe or is it better to receive a refund? So I'd just like to know if you wouldn't mind putting that in the chat. Do you think it's better to owe or to receive a refund? All right, so see, receive, better to receive, better to have a refund, receive. All right, so this is another one of those answers where it actually kind of depends, but typically you'd prefer to owe. If you owe, that means that you actually kept the government's money. Okay. Now it depends, and the reason it depends as to whether it's better to owe or receive a refund is because if you don't pay the government enough money and you owe them too much, then you actually will have to pay them interest. Okay. So most people get excited because they receive a refund, but receiving a refund just means you loaned your money to the government over the course of the year. So in theory, when you file your taxes, you actually want to get as close to zero as possible, especially when you're a W-2 employee. You would prefer probably maybe to owe a little small amount or to receive a small amount in a refund. Ultimately, the difference between whether you owe or whether you receive is just simply based on how much in taxes you actually paid the government throughout the year. Okay, so I get a lot of questions about, from people, why is it that my refund went down this year? Or why do I owe money this year? And that is basically determined by how much money you pay the government during the year from your actual paycheck. Okay. So moving on to the next slide, we're actually going to move out of this and we're going to actually look at a tax return. So we're going to start by looking at the most basic tax return, which is the U.S. Individual Income Tax Return Form 1040. So I'm going to go through the basics of this. At the top, this is just your information. Okay, so are you single? Are you married? Filing together? Filing separately? Are you the head of household? In other words, are you single and taking care of somebody like a child or a grandparent? Are you a qualifying widower? This really only comes up if somebody passed or your spouse passed in the year that you're filing this tax return. Then you fill out your basic information. Come down here, fill out some more information that will help as far as taking a potential standard deduction. Then you get down to the meat of your tax return, which is your income piece. So lines 1 through 10 or 1 through 11 are basically accumulating all the income you earn throughout the year. So line 1 deals with your wages as well as your W-2 income. You then get into some more details with tax exempt income, qualified dividends, etc. We come down to line 11 that we have highlighted here. This gets you to your adjusted gross income. From your adjusted gross income, you then have the ability to possibly take what is called a standard deduction or an itemized deduction. And we'll go through itemized deductions in more detail in a moment. The simplistic goal is that you want to take whichever one is larger. So if your standard deduction is bigger, in other words, your standard deduction is typically $12,500 or so. If that's bigger than your itemized deductions, you take the standard deduction, and that reduces your income. So again, if we have $100,000 in income and a $12,000 standard deduction, the amount we owe taxes on is now reduced to $88,000. Okay. We then have a couple other deductions we could take, and then that takes us to what is called our taxable income on line 15. So this is essentially the potential income that is going to be taxed. We scroll down to the second page. You'll look here at line 16. This is the tax or the estimated amount that you owe. From there, we then start to get into the credits. Remember, a credit reduces the amount that you owe in taxes dollar for dollar. So you'll see here, for instance, you have a non-refundable tax credit. You'll see some more here in a second, but you'll go through this tax line. We get some credits. You have some additional taxes you might have to add in. You then get to what is called your total tax that you owe. This is then reduced by any withholdings that were withheld within your paycheck. So you'll see here your Form W-2, that's withholdings that you would enter there. You keep going down, you have some more income tax credits that can reduce your taxes further. So you have that earned income credit. You also have the American Opportunity Credit, Recovery Rebate Credit. All of these things can actually reduce your tax bill. You come down to the bottom. We look at line 32. This gives us the amount of refundable credits or other tax payments we've made for the year. Line 33 is our total payments. Basically, the amount of tax that you owe on line 26, less 32 and 33, gives you whether or not you are going to receive a refund from the government or you're going to owe. So again, it's all based on what you've actually paid throughout the year, whether you get any credits, etc. that ultimately determines whether you receive a refund or whether you owe Uncle Sam. Okay. So moving on here, you'll see we also have business tax deductions. So Form 1040 is mostly for W-2 employees, but then you also have a piece that gets added into this for 1099 employees. So remember, 1099 is typically for independent contractors, businesses, freelancers, etc. So we're going to look at Schedule C, which are business deductions. So that's why determining whether you want to work for somebody or work for yourself is important, because at least with a 1099, you get business deductions. But the other downside is you do have to pay your side of Social Security, or excuse me, your half of self-employment tax. So you will see here, this is your Schedule C, profit or loss from a business. Same thing at the top again, you have some basic information you have to put in for your business. On page 1, you have what are called your gross receipts or sales. So in other words, if you sold, $10,000 in widgets, that's where this would go. You put $10,000 in here, you subtract out any returns or allowances, whatever the cost of those widgets were, and then you get to your gross profit. You could have other income that comes in, and then you get to your gross income. But the point that I really want to make here is that when you're a 1099 or you run a business, you have a lot of expenses that you can deduct. So for instance, you can deduct the car and truck expenses. So mileage that you drive. So if you have to drive to a workplace or you have to drive to a client, you can deduct that. If you have employee benefits, you can deduct those as well. In other words, if you pay for your health insurance. You have travel and meals that you can deduct. So if you have to fly to go see a client, or you have to take a bus to go see a client, or you take them out to eat, you can deduct those meals. So there are a lot of benefits to having your own business as well. And so I just wanted to touch on a few of these deductions without going through all of the nuances of them, because it starts to kind of separate, okay, what does a W-2 look like versus a 1099? Okay. So continuing on here, let's talk about taxes on what you buy. So most people are familiar with this, especially in the state of New Jersey. The state of New Jersey has a 6.625% sales tax. Now, if you go to our friendly state to the south of us, Delaware, they have no sales tax. But anything you purchase in the state of New Jersey, if you purchase a car for $25,000, you are going to pay sales tax on that vehicle. So you see there, I put an example. Roughly, you'd pay $1,656 for a $25,000 car. So it's important to know this because a lot of times when you go to purchase a car, everyone thinks about only the price itself. But you have to remember that sales tax is also going to be included in that, especially when it comes to your monthly payment. So other things that you will pay taxes on when you purchase them. So homes typically have some type of transfer tax. You buy shoes, obviously cars, prepared meals. So when you're in a restaurant, if somebody is preparing that meal, or if you're eating at Chick-fil-A or something like that, you pay tax on that, okay, because it's a service and you're purchasing essentially that service. You're also going to pay taxes on electronics. So anything you purchase, you're going to pay a tax on, especially in the state of New Jersey. All right. So let's go to the next type of tax, which is taxes on what you own. So for example, real estate taxes. So tax types on what you own are going to be real estate taxes, capital gains taxes, wealth or inheritance taxes. So these are things that you typically purchase and hold for a long time, or at least you should hold for a long time. And they're also taxed. So some other examples of taxes on what you own are going to obviously be homes. It could be real estate properties. It could be warehouse buildings. It also could be investments such as stocks, bonds, or other securities. When those pay you interest, income, or dividends, they are also taxed. When it comes to inheritance or wealth transfer taxes, if you owned a business or your family owned a business and it's passed on to the next generation, there's a possibility you're going to owe taxes on that as well. So if you're catching on to the theme here, it seems like no matter what you do, the government is going to tax you. So the more transactions you make, the more it reduces your overall income because the government starts to take those dollars. Okay. So the more you can minimize transactions, the more money you tend to keep in your pocket over time. So I have an example here I want to that I think helps to pull all this together. So your dollar at work, one of the most important questions that you can deal with as as a financial advisor, right? And even as somebody who is young, is are you working for your dollar or is your dollar working for you? The more you can start to make your dollar work for you, typically the better off you are when it comes to minimizing taxes. So what I want to look at is your dollar at work. Okay. So if you look down the bottom of this slide, you'll see what I did is I broke the dollar up into how your taxes are allocated. So let's say that you make $100,000 a year. Your federal tax bracket will roughly be 22%, depending on whether you're single or married. And the 22% tax bracket, that means each dollar that you make above this amount is going to continue to be taxed at 22% or higher. So almost the first quarter of your dollar goes to the federal government. If you're a W-2 employee, you then pay the payroll tax or self-employment tax. So your half of self-employment tax is 7.65%. That tax goes directly to what they call FICA and FUTA, Medicare. Essentially, it's going to Social Security, Medicare, Medicaid. Okay, so those are all the social programs put in place to help people. Next, you don't escape New Jersey's tax. You then have a 3.5% tax for New Jersey. Okay, so that's their income tax rate. Then I said, you know what? Let's figure we own a house. State of New Jersey, real estate taxes are not cheap at all. So if we made $100,000, let's just assume about $10,000 of that is going to the real estate taxes. So that's another 10% of your income. Okay, so before your money even gets into your bank account, 43% of it is going out. Essentially, the first 2 days of the week, you're working for the government. So you want to try and figure out ways to minimize these taxes. Okay. Then on top of that, so now let's say we have 57% of our money left. We then go and spend the rest of that on different things. If we're spending it on cars or we're spending it on electronics, things that have sales tax associated with them, another 3 to 4% of your money is actually being lost. Okay. So taxes can, in some ways, be helpful if you know ways to minimize them. If you don't, they can also be extremely hurtful. So the next slide is your dollar at work. Okay, where you are not doing the work for your dollar, but your dollar is working for you. So let's say we took that same dollar and we decided to purchase Apple stock. I figure most of you are familiar with Apple. Let's say we purchased Apple stock at $100 a share, and Apple went up to $200 a share. We now have a $100 gain on that stock. Well, if we hold this stock, then what we will pay is called capital gains tax. Capital gains taxes are typically lower than ordinary income tax or taxes on what you earn. So if we're making $100,000 a year, our capital gains tax is likely to be 15% as long as we hold the stock for a year. If we hold the stock for less than a year, then we pay our normal federal tax bracket, which again, if we go back to the previous slide, is 22%. So just by simply holding the stock for a year, we reduce the taxes on the gain that we have down from 22% to 15%. We'll still have the New Jersey income tax at 3.5%. And so the total amount that we pay in taxes on this dollar is 18.5%. Much lower than the 43% you're paying on the dollar that you're working for. So the more you can start to take the dollars that you're working for and reallocating them into dollars that are working for you, it's like that you will reduce your overall tax burden in time. So continuing on here, the importance of taxes. So the importance of understanding taxes. It's important to understand taxes because they can help you minimize and defer the amount of money that you pay to the government over time. And the more you can minimize that, keep more money in your pocket, the better off you will be. It will help you to make educated decisions in the earning of your income, okay, as well as purchasing and sales of assets. So we're going to talk about tax minimization. How can we minimize taxes? So we're going to take a look at what is called a tax control triangle. And this is important because this deals a lot with deals a lot with retirement. Okay. And you'll see here there's 3 buckets in this tax control triangle. First is going to be taxable income. Next is going to be tax deferred growth. And then finally, tax-free growth. Most people are familiar with this bucket down here. This is your taxable income. This is money that comes in from a paycheck after tax. We could then use it to purchase something like a real estate or a rental property. While you own that rental property, again, you're going to pay real estate taxes on it. When you sell that property, there's the potential that you're going to pay taxes on it again. So you're taxed 3 times in this bucket. Long story short, Uncle Sam, the government, they love it if you're in this bucket because you just continuously pay money to them. The next bucket is tax deferred growth. So such things as a 401k or an IRA. Money goes in here pre-tax, grows tax deferred, and then in retirement, Uncle Sam wants his money back and it comes out taxable. So here you're only taxed once and that's on the way out. Third bucket, tax-free bucket. Money goes in here after tax, grows tax deferred, and then comes out tax-free in retirement. So you only pay taxes on the way in. An example of this is a Roth IRA or Roth 401k. So utilizing these different buckets, trying to minimize the amount of taxes that you're paying is ultimately what's going to help you grow your pool of assets and your net worth more significantly over time. So going back here, as far as tax minimization is concerned, when it comes to tax referral or tax deferral, at least for retirement and medical expenses, these are some examples of things you can utilize to help you reduce taxes today, defer them into the future, or even minimize the taxes that you'll pay later on. So you'll see here we talked about a pre-tax 401k, Roth 401k, traditional IRA, Roth IRA. Typically the 4 on these 4 over here for W-2 employees for retirement. You also have 2 others, a SEP IRA and a simple IRA, which are for retirement, and those are usually for 1099s or businesses. Okay. The other 2 here are medical savings accounts. One is an HSA or a health savings account. The other is an FSA or flexible savings account. Both of these are one of the few ways in which you can get money into them tax-free, let them grow or invest them, and they will accumulate dollars tax-free. And as long as they're used for qualified medical expenses, you can also take them out tax-free. So these are triple tax-free. And these could be extremely important to use, especially if you have medical expenses, if you're having a child, getting ready to go into retirement, etc. So moving on to the next slide, as far as tax minimization, there are some tax deductions that you can take. So from a W-2, even a 1099 standpoint, again, you have that option to take what is called the standard deduction or the itemized deduction on your Form 1040. So the standard deduction, again, is typically, I think it's $12,500 this year. So in other words, the first $12,500 that you earn is technically tax-free to you. Okay. But again, let's say that your itemized deductions are actually more or greater than your standard deduction. Then you would actually take your itemized deduction to reduce your income and reduce the amount you owe in taxes. So itemized deductions appear on Schedule A. So we'll take a look at a Schedule A real quick. So Schedule A, itemized deductions. You have different categories for which you can take deductions. You have medical and dental expenses, taxes you've paid. So this typically comes into play when you own a house. So such things as real estate properties, real estate taxes, state and local income taxes, state and local taxes, which include, sales tax that you're paying. You then have interest that you paid. So if you own a house, you have home mortgage interest deductions. You also have gifts to charity, casualty and theft losses. In other words, if your property happened to be destroyed due to a hurricane or a flood, you can potentially get a deduction for that. And there's also some other itemized deductions. But all of these are ways to minimize your income tax. So the more you're familiar with this Schedule A, the better chance you have of potentially reducing your income taxes more than just the standard deduction. So to come back to this, again, these are some examples that we just talked through. One thing that would likely be important for all of you is determining whether or not you qualify for what is called the student loan interest deduction. Okay. So again, you'll want to discuss with your accountant, or whether you use TurboTax, H&R Block, as to whether or not you qualify for that student loan interest deduction. So the next piece of tax minimization are credits. Remember, credits are taken off of the amount of tax that you owe. So it reduces the amount of tax you owe dollar for dollar. So these are 4 examples of different tax credits. You have the earned income tax credit. Typically, this applies depending upon the amount of income that you actually make. You have 2 credits here that I starred because they may be beneficial to you while you're in school. One is the American Opportunity Credit, which is an education credit, and the other is a Lifetime Learning Credit, which is also an education credit. The other one you have here is a child tax credit, and kind of as its name implies, if you have a child, it's likely that you will receive a credit for having a child. Okay, so it's important to know about these credits. You can always double check your accountant, make sure that they are taking these for you. All right. The other thing when it comes to tax minimization, we talked about this earlier. We looked at a Schedule C for business deductions. Again, if you're a 1099 contractor or you own your own business, these are deductions that you can take to reduce the amount of taxes that you owe the government. Okay. Some of these are what we would call non-monetary deductions. In other words, you don't have to actually spend the money to get the deduction. An example would be mileage. Okay. Other examples might be what we call depreciation, which is just a reduction in the value of a asset, such as a warehouse. Other deductions, though, you have to pay for in order to get that deduction. So, for instance, travel or meals, legal and professional services. One other benefit of having a business is that if you use it as a home office, you could potentially deduct part of your house for utilizing it as a home office. You have a piece of your utilities that you could also deduct as a business expense from your home office. Okay. So there's just a number of deductions when it comes to this, and these are important in minimizing your taxes. So to kind of recap and summarize here, we started out by talking about a flat tax and graduated tax. The U.S. government uses both of those. All right. It is important, though, to understand the 3 types or 3 categories of taxes, which are taxes on what you earn, taxes on what you buy, and taxes on what you own. Understanding that will help you to reallocate dollars as they come in to hopefully minimize taxes down the road. You also have deductions versus credits. Understanding both of those can help you to minimize your taxes. The other thing that's important is understanding how your dollar is working for you. When you earn money from an employer or even dollars that are paid to you as a business, it's likely that those dollars that you earn are going to cost more money than if your dollars are working for you. In other words, if they're invested in a stock or bond or rental property, etc. So one of the most important reasons to understand taxes is to identify ways to hopefully minimize the amount of taxes that you're not only paying today, but that you also pay in the future. So I hope this was helpful. It was a relatively high-level overview of taxes and how they can affect you. Ultimately, there's a lot more that goes into it, but I'm hoping that this starts to at least just give you a brief inclination into what's going on when your accountant or your TurboTax H&R Block software is going through the actual tax implications of what you've done in the last year or so. So looking forward to answering any questions that you might have. At this point, we'll open it up to any questions that anyone has on the chat.
Anybody have any questions? You can put them in the chat or you can unmute yourself if that is easier for you to ask.
There's no way I did that good of a job explaining taxes. So any questions on, taxes, how they affect you? What is the main difference between a credit and a deduction? All right, so thank you for your question. So a deduction is basically done on the top end of your income. In other words, if you make $100,000 and you have the ability to take a deduction for the real estate taxes that you paid over the last year. So let's say that those real estate taxes cost you $5,000. That allows you to reduce the amount of income that you earned from $100,000 down to $95,000. So that means that the amount that you're going to be taxed on is now less, which means you will pay less to the government. As far as a credit is concerned, a credit is then taken from the amount that is taxable. So if that $95,000 amount is what is now taxable to you, and that basically translates into $20,000 in taxes that you're going to owe the government, a credit is taken from the actual amount that you owe the government. So if you owe $20,000 in taxes to the government and you have a credit of $2,000, that's going to reduce your tax bill by $2,000. So you will now only owe $18,000. So hopefully that helps. The only other way to try and make it more clear is probably to go through a tax, actually go through a tax return with numbers. So hopefully that helps though. How does pandemic unemployment affect your taxes? So good question. It does depend. It depends on whether or not you were withholding taxes when you were collecting unemployment. So if you were withholding taxes when you're collecting unemployment, then it is likely you will not owe a lot in taxes. But the important thing here is that when you collect unemployment, you do typically have to pay taxes on that unemployment. Okay. So if you are ever unemployed, it is usually best to have them withhold taxes for you. Although most people don't realize or don't know that they can have that, and they won't have it withheld, and then they have a gigantic tax bill at the end of the year. So hopefully that helps, Dana. Simarjeet says, do you pay taxes for if you did not withdraw money from investments and earn less than $50 from dividends? So it depends. I mean, if you only have $50 in dividends, there's a possibility the company that you have your investments with may not issue what is called a 1099. Could be a 1099 DIV, 1099 INT. Long story short, that's just a receipt from you to tell the government, hey, you earned money and you need to pay taxes. Ultimately, it depends. Usually there is what they call a de minimis amount. It's usually $10 though, I believe, not 50. But you'll want to check. You'll definitely want to check with an accountant on that. The other thing though is a withdrawal doesn't necessarily determine whether you're going to pay taxes. It's if you bought or sold something. So if you sold a stock or a bond, for instance, and you had a gain on it, then it's likely you're going to owe taxes on that gain. Okay. So hopefully that helps. So Preeti says, I was asked, did I owe taxes? Does that mean did I file for taxes? Or does that mean did I owe money to the government after filing for taxes? So I'm not 100% sure I fully understand your question, but if my guess is whether or not it sounds like maybe somebody is asking if you owed taxes. And so if you owed taxes, that means usually you are paying the government. So that means that throughout the year, you didn't give the government enough money, and now the government's coming back and saying, all right, we need the rest of our money. And so likely that means you would owe taxes. So hopefully that helps.
These are great questions. I'm glad people are putting some things in the chat. Does anyone else have questions or anything they want to ask more about?
So I will ask all of you, when is the deadline to file your taxes this year?
Anyone, you can put it in the chat. When is the deadline to file your taxes?
Is it April 15th?
Yep. So typically it is April 15th. This year though, so usually if April 15th falls on a Friday or the weekend, they usually make the deadline the following Monday or the following business day. So taxes are actually due this year on April 18th, but normally it is April 15th.
Other questions? Okay, well, I first want to just say thank you to Mike for this great presentation. This was really helpful and informative. I hope it helped you all. We did record the session, so I will post this for EOF on our Canvas page, and I will also send this to Dr. Corley so he can distribute to any TRIO students. We will hang out for a minute or two after the presentation. So if you do have like a specific question you want to ask, feel free. Otherwise, I hope you all have a great day.
Yep. I hope you all have a great day as well. And thank you for joining.